Maximus Analysis here for July 28th, and I wanted to give you some educational material. I mentioned numerous times on my daily videos about rolling options, or you being able to roll your option. I want to give you an example based on something that I gave in the newsletter and currently where we are now. So in the July 8th newsletter, I put in this material. So I put in that DuPont continues to make higher lows and holding a big swing midpoint of 61.94. Overall market still start to perk up, and this name could definitely move in a major way. Clear break of this week's high, which breaking above this previous high right here could move past 64.67 and could see a retest of the 70 to 84 area. The turn date is this week, and August 29th is another one to mark on the calendar. Okay, you can see the chart here, and I wanted to show you that so again you can see what's going on, and then also see this is where the chart is now. So it got up to very close to that 70.84 area, so you can see it got to as far as a high of 69.87. So again, I'm not going to be a super stickler. The other target would be 72.84. Either way, if you got into the options on July 11th, this is what we would have going on here. Let me see if I can get rid of this. Okay, good. So what I did was I used the Thinkorswim on demand. So this actually showing the contract pricing on the options chains on July 11th at the open. Now I don't suggest trading the open, but again, I just want to give you an example here. So you can see that what I would have done is basically that was at around 64, so I would look at the option chain, and I don't like to take anything less than 45 days to 60 days out to give myself some time for the move. 102 days seems like a lot, but again, the risk will be the same. It's all based on price difference of where your stop is, and multiplying that by the delta is a quick and easy way. So let's say we got into the 65 call. The 65 call spread is 225 and 295 for the ask. So I pretty much split the difference of that. That's about what, 70 cents. So I take 70 cents, divide by 235 on top of that. 35 on top of the 225 will give us around 260. So let's say we just take that amount to say, okay, first number to write down for yourself is 260. Yeah, let's say 260. And let's say we had the benefit of doubt and got filled on that. Now what I'm going to do is take this on demand off and see where these October 16th 65 calls are today. Okay, cool. So they're 85. As you can see, the days have passed. Let's see where the 65 calls are. So 65 calls now are 510 bid, 560 ask. So let's take a midpoint of that. Let's say we get 535. So you take the numbers. Let's just put the calculator up and say, okay, we take the quick and dirty is 535 minus the 260, right? So that means we made $275 per contract in profit so far based on the trade. Now you're saying to yourself, because of the way that the price action moves, I don't want to give up, and I know many of you have been in this situation, that I don't want to give up this entire move of profit, because I know there might be a pullback, being that there's already 1, 2, 3 bars in, and I can roll my stop here. But sometimes when you roll your stop, which you put a stop limit in underneath the price, and again you take the difference in price by the delta. So right now it's at 60, let's say 69.17, and the low, say just for argument's sake, would be 68.17. So that's risking $1. Let's say you have a 50 delta, that means 50 cents minus what the current price is, which would be basically like putting it at $5. Either way, you say, listen, I don't want to do that. I only have a couple contracts that I'm in. What can I do? And then what I say for people to do is to consider rolling your option. So let's say you have one option, you sell it for $275 profit. So you have $275 worth of profit in. What I'll do is look at the options and say, okay, I have 85 days left on this option. Let me buy the 72 50s. Now some of you might, why would hell would I do that? Because I want to lock in at least half of that profit. So if it went to hell, I would say, okay, at the end of the day, I know I still locked this in, even if these went to zero. So let's say the midpoint between these is about 115. So I would buy for 115 the 7250 calls, and that means that what I've done then is take this 275 minus out the 115, and now I know even if this trade goes to hell and these new ones get rolled out, or it gets, it doesn't move anything and it continues to go down, I've locked in $160 worth of profit. And the reason why you do this is because, again, some people are only trading one contract, and I try to put my everything that I put onto the videos and the education to be scalable, to say, okay, at the end of the day, I can do this with one contract or 100 contracts. I could do this with 100 shares. I could do it with 10,000 shares. The process should be the same. So the 65 is what you bought before, and you roll out to the 7250s. Okay, so you're rolling your option to something you could either do further out in time if you didn't have that much time left, and then again you adjust your pricing. But you know that at the end of the day you've locked in that $160, and you still are able to participate in the move, versus what sometimes a lot of people do, especially if they're trading smaller size, is they'll be like, I'll take this off because I want to lock in some profit, but I don't want to give up. Basically, I don't want to give up that if this thing gaps down or gaps up. And this is something that I'll definitely do sometimes over earnings, because I'm like, at the end, the worst case scenario, the one that I roll into would evaporate to nothing. So this is an option that you can put in to still stay into the trade, but then lock in some profits on your P&L. And it has been something that I've found very, very valuable over the years, because you can get into small, very, very high, like this move. Let's say this move runs up and you only have a couple contracts, and you're like, I'll take it off at 60. Let's say we're right here, right? Let's say we're right here. You take it off here at 60. You see it run up another $10. You're annoyed as hell. What I say is, roll your option to something else. Give yourself some, hopefully you still have enough time in the option, and you might not make as much, but you're still in the trade for moving up or moving down. So let's say you see a flash down here. You could roll your option here and say, okay, I still want to be in the move, but it's moving so violently, let me not give up anything, and then I could participate in the move up or down. I've seen that this has helped many people stay into trades that they wanted to be in, and instead of having just a dire dead stop on the options, because remember the options markets are open from 9:30 to 4 o'clock, that you have the opportunity, because if it gaps down overnight, your option is going to get crushed, and that stop is going to get ran through, and then you got to do your adjustments. I find that this is a much easier way for me to manage my trades moving forward. So again, if you have any comments or questions, feel free to leave comments below, or you could also email me at MaximusAnalysis@gmail.com. Also, if you don't get the newsletter, email me again at MaximusAnalysis@gmail.com, and I'll get you on the mailing list for the week. I usually send it out either Monday morning at like 6 a.m. or I send it out on Sunday. All right, take care, and I hope this was helpful.